Hey, welcome everyone. My name is Jose and I'm a stacker. I'm here with Summit Metals. Today we're going to be talking about how you can dollar cost average and it gives you a better ROI than if you were to do a lump sum on your purchases. So stick with me and we'll go through the case study between 2022 and 2024. So, what is dollar cost averaging? It's investing in a fixed amount of money at a regular interval regardless of market conditions. So how does it really work? Well, it's basically spreading out your investments month by month or week by week or however frequent you'd like. So an example that we can provide in dollar cost averaging is putting $1,000 a month for the next 24 months versus doing a lump sum $24,000 purchase into precious metals. How does it benefit you? Well, when prices are high, your fixed amount buys fewer ounces. Thus, you get less weight of metal. But when prices are low, your fixed amount buys more ounces. That's all about timing the market in order to actually win out. You don't really win in the market all the time. It's a 50% chance. So, what happens as a pro when you dollar cost average, or at least buy in a frequent amount? There's multiple different things. One is you protect yourself against the volatility of market fluctuations. You also get to build a stronger investment habit in saving instead of spending. The data shows that dollar cost averaging does actually increase your ROI over the long term. And I'm going to go through the slides to show you how that really works from April 2022 to April 2024. However, there are some cons to this approach. Sometimes buying at the lowest point can make you win a larger amount of ROI, but it stops you from the habit of investing in a frequent basis. You may be able to buy also at the all-time high, and if it dips, you basically lose some money in terms of being able to purchase more weight of gold, silver, platinum, whatever investment strategy you have. If we go here and we look at this gold case study, dollar cost average versus lump sum, you can look at the comparison. If I were to buy 1 ounce of gold each month versus buying 24 ounces of gold all at once on April 2022, what does the data really show? If we look at the right side of this graph, we can see a person who does a lump sum of $25,000 April 2022, their total holdings after 24 months is approximately $28,572. But if an individual actually does a dollar cost average, buying every single month for the next 24 months, their total value is more than the lump sum purchase, around $29,360. That basically amounts to around a 3.15% increase from doing a one-time purchase. Now, there's a lot of benefits to this approach with dollar cost averaging. Not only did the person get a higher ROI, but they also practice the strategy of investing every single month and saving, which is really hard to do because you could have that money in lump sum potentially and spend it all on something else. Now, if we move on to a different result, which is silver as a case study for dollar cost average versus lump sum, we can see a person who decides to purchase around 21 ounces a month for the next 24 months, amounting to approximately 500 ounces of silver versus someone buying a monster box all at the start. The data then shows a bigger deviation in terms of the ROI doing dollar cost averaging. Now, if we look at this graph one more time, except that this is for silver, we can see that a person who actually decided to do a dollar cost average with silver won out ahead from a lump sum by almost 8%. The benefits are there. Dollar cost averaging does help an individual gain a larger ROI over time and gives them the ability to flex their muscle in terms of saving every single month. All right, so when we look at everything, what does it all mean? Well, gold, 3% gain on dollar cost averaging. Silver is over 8%, and when combined, you're looking at your portfolio changing dynamically to almost 20%. This is why dollar cost averaging is the way to go. So now we've seen dollar cost averaging, and we've also seen lump sum and how it impacts your investment over a 24-month period. Which should you choose? Well, at Summit Metals, we recommend you take a hybrid approach. If you go watch a video that was posted a couple weeks ago by Eric, you could see that the recommendation is to do a lump sum between 30 to 40% to get into the market, while the rest should be dollar cost averaged. Why would you want to do a dollar cost average and this hybrid approach? It's to protect your investment against market volatility. This smooths out your average cost over a long time period. Now, that is the main reason why we promote dollar cost average. So if you're really interested in dollar cost averaging and getting started, just go ahead and visit our website at summitmetals.com. On the top right, you'll see Auto Invest, and it'll teach you how exactly you can start. You pick the metal that you like, whether it's silver or gold, and the quantity that you'd like. And on the first of every month, depending on what the spot price is, you'll get charged, and we'll start delivering it to you on the 15th of every month. It's that easy. And if you don't want it delivered to yourself, you could use our private vault storage and store it in your private vault that's segregated. Now, this is really exciting that you're here with us, and I really want to see you comment, like, and subscribe so that we can produce more content that is both educational and helpful towards your investment journey. Take care. Happy stacking.